A regressive tax is a system that creates a unique burden on taxpayers regardless of their income level. The term regressive refers to how the tax rate moves in relation to a person's total income. In a regressive system, the lower your income is, the larger the percentage of your earnings you pay toward the tax. Common examples include sales taxes on basic goods or specific excise taxes, which impact smaller budgets more heavily. This is the opposite of the progressive income tax system, where rates increase as your total income grows. When a tax is flat, like a sales tax, it represents a much larger slice of a limited monthly budget. Remember that the classification of a tax depends on the total percentage of income taken, not just the technical tax rate. Understanding tax structures helps you better grasp how public policy affects your personal finances. Subscribe for more financial literacy basics.